So Mark is going to talk to us a little bit about the second key to our clients' confidence, which is diversification. You know, you hear us talk a lot about that, but this is going to go beyond just the basics of diversification. So Mark, take it away.
Thanks, Sarah, and welcome everyone. Thanks for joining. As Sarah mentioned, did a nice job of explaining there's things that we can control here for our clients. One of those is just planning for uncertainty and doing a lot of things to help manage that process when things get both good and sometimes challenging in markets. The other thing we do for a lot of our clients, which is very key in determining their ability to have a successful investment experience, is just how we diversify. And I know that word is used loosely in a lot of times in investing, but the way we think about diversification is that we're very deliberate. We try to control what we can control, and we do everything by design for the benefit of our clients. And one of those, as you see by the title here, is diversifying beyond the basics for our clients. As you see the slogan, we like to own clients or like to own a lot of the great companies of the world, and then some. And if we go to the next slide, we'll kind of jump into something that I've shown before in some of these webinars with many of you or in one-on-one meetings. This whole notion of this 60-40 rule, where did it come from? You see it thrown out there a lot these days. And we're not saying it's good, bad, or ugly. It depends on the client situation. All we are saying is that let's understand where it came from and whether or not it's appropriate for our clients and how to utilize other information for investing. And the 60-40 really came about many, many years ago by some Nobel laureates. And it just said, hey, here's a way to allocate given what's available in markets. As you can see, it's a little bit small and noisy in the middle there. Back in the 50s and 60s, there wasn't that many ways to invest in public markets. You had big companies, you had bonds, you had treasuries, and maybe some other investments, and that was it. So that's really kind of how a lot of the investment ideas and ways to invest evolved since the 50s and 60s. But as we've evolved over time for our clients, we try to figure out ways to continue to diversify given our access to additional investments that we have now today. So if we go to the next slide, Jordan, it's definitely over the last 40, 50, 60, 70 years exploded in mostly a pretty good way in terms of giving our clients access to investments that maybe can help not just diversify, increase return for their future goals and objectives, but also maybe just manage risk a little bit better throughout that experience and that process. So what we're looking at here is just this, it comes out every year in the beginning of the year, this overall 10-year forecast. And as Sarah mentioned, and she'll talk about it in a minute as well, we don't like to try to forecast or throw darts or speculate on what's going to happen next. But a lot of the collective, wisdom of the crowd here gets together every year and comes up with what they think is going to happen for the next 10 years going forward for all these different areas of the market, also known as asset classes. And as you can see, there's this whole, you've seen US stocks, US fixed income or bonds, real estate, private debt, private equity, emerging markets, a lot of these, and not even everything's even listed here. And all they're trying to come together and say is, here's on average, as a crowd, what we think these asset classes might average per year for the next 10 years. Now, are they going to be right? Let's be clear, probably not in every situation. There's going to be other asset classes or some of these asset classes that might do better or worse than they forecast. But the purpose of showing you this is that, look, we're going to go beyond just traditional stocks and bonds for almost all of our clients of all ages at all times, especially where we can definitely better manage risk and maybe even increase return. And just a quick note, some people might have said when this came out at the end of the year, emerging markets being one of the best potential performers for the next decade, we might have got laughed at or thrown out of the cocktail party. Well, it has been a decent return asset class year to date over some of the things like US stocks or US fixed income. So again, this could always change, but you never know. And the point of this is that we diversify a lot, so we don't have to guess, speculate, or try to throw a dart on what's going to happen next. Let's go to the next slide. Now, while I've talked about things that we might include when it comes to other asset classes, like, foreign stocks, private equity, private credit, fixed income, which is one of the most basic investment vehicles, also known as bonds to some people, it's one of the most basic investment vehicles out there. And why I say that is because bonds have historically been a way to diversify stock market risk. Now, I bring it up because Some people may find fixed income or bonds boring. They may stick with what they know in terms of buying corporate bonds or treasuries, but a lot of people don't realize, and a lot of professionals don't realize how bonds really work. And so one of the things this slide is showing, it says P&L from $1 million invested in just a broad bond market index, the profit and loss. And profit and loss for bonds is not just the price going up or down, it's also dividends and interest being paid. The point of showing you this is that, look, there's also things that we do include for client portfolios, but there's also things that we avoid because we think that some of the stuff you will lose money in if you invest in. And especially given how interest rates over the last 30 or 40 years have changed, i.e. they're much lower than they used to be, there's a lot of risk that exists in owning fixed income. Either you don't achieve inflation, you're at the mercy of interest rates in terms of profit and loss, or you're just not going to help yourself earn the return you need for the future. And in this example here, some people might say, well, wait a minute, Mark, I see that every year you're showing here, for the most part, bonds made money. But what happened in 2022? This right here is not junk bonds. This is not, a high yield bonds or things that were not that great in the fixed income arena. These were just highly rated investment grade corporate bonds. Your Googles, your Walmarts, your Microsofts, the treasuries, they lost money in 2022 because interest rates went up. Now, we don't try to speculate, but given the information we have, we do know that things happen. And for a lot of our clients, we will avoid areas where they're not going to get paid to take the right kinds of risk. And this is a big, big area. As many of you know who invest with us, yeah, we own some traditional fixed income, but very carefully. And we own other areas in this asset class because we feel we owe it to our clients to do better, to not just get better returns, but also to avoid doing what we call some of the stupid things out there in the marketplace that will cost you money. So again, we're very deliberate when it comes to this area. And many of you know we've been able to not just do this past year, the last couple of years, we've been doing it since back in 2018 and 19 when rates were going down close to zero and very low already. So a couple thoughts there. Next slide. And when I say investing with purpose, this is a good example. And we're not trying to cherry pick. We're just blindly looking at what happened in a year like 2022, which we just highlighted. You saw stocks go down, right? Almost 20%. Those are just public stocks. Bonds, if you just bought traditional stuff, you lost money. Even treasuries, you lost 13% or close to it. Now, as many of you know, we don't just buy traditional stuff only. When it comes to bonds, we buy a lot of other things. So our experience for clients was much better. Compliance might not like me saying that, but it was. And alternatives, we do diversify in alternatives, whether it's public or private, because it's something that, again, we're not necessarily trying to get the highest return for our clients. Our clients, if they do the right things, don't need to get the highest return, but they have to have a good positive return over their investment lifetime. And so by inserting some of these alternatives, right, and the way we know how to insert them as part of a client portfolio, it can not just ensure they achieve those goals, but we also can avoid some of the bumps that happen to the downside, like we just saw in the markets. So we like to, go beyond traditional investments when it's appropriate for our clients, just to help better manage risk, manage inflation, or the crisis or uncertainty of the day, as we call it here at CAM. Next slide. All right, this one's a little noisy, but it's just a very broad, basic example of that 60-40, looking at stocks and bonds. If you started to dabble in other different asset classes beyond just stocks and bonds, you can see that down here, it's a little hard to read. The return, about almost 9% over this last, 8-9 years, approximately. Volatility is what it is, and the yield. Here, blindly just adding some other asset classes beyond traditional stocks and bonds, it might get you a little higher return, but it definitely reduces the volatility. It reduces the bumps. So for a lot of our clients, again, some people out there in the marketplace might offer some of these asset classes, alternatives or private investments, just to look cute or try to sell something. We're doing it only when it adds value, net of fees and taxes for our clients. And that's really, really important to understand, because we don't want to have you invest in things that you don't need, right? But we know that almost all of our clients don't take on 100% stock risk or 100% equity risk, right? Because they don't need to, and not everyone can stomach those bumps. So we try to incorporate things where we think they're going to add value in a very deliberate way, and this is an example of that. Next slide. And then just kind of rounding out my area here, my section here, we definitely like a process. We like a framework. You've heard us say that for many years. When it comes to public investments, we keep it very simple and deliberate. We like to diversify, keep things low cost, tax efficient, very simple, right? I think if the media and the magazines told you that out of the gates, they'd be out of business, right? They have to keep telling you something to keep you coming back. We do that for public investing very deliberately and have done it for many, many years. We will utilize the investment alternatives if they can provide that value and be persistent and just, invest in non-traditional markets where it helps you achieve your goals. And here's a list of some of the things we do invest in for clients. You can go down the list and compare your own lineup. You can see there are some things that are different perhaps than some of our investors maybe have had or have now or may have in the future. But that's kind of an overview of some of the specifics that we do, especially in times like this.